Good evening, everyone. So, just before starting the session, I just thought it's important to give a little bit of a background, and then we'll open the discussion for the esteemed panel. Now, a distress situation arises the moment there is, inability of a corporate debtor to pay or meet its payment obligation. Now, so far, what we have seen historically is that any kind of distress situation was resolved more under the CDR JLF framework. But then thereafter, it has got replaced by the June 7 circular, which is a RBI circular, enabling resolution of a distressed asset or a corporate debtor under a contractual or a bilateral framework. Now, that framework basically enables a distress situation to be resolved, but it is only a bilateral framework and a contractual framework, not binding on all stakeholders. And also, what we have also realized is that a lot of investors are wary about participating in that because of the black hole, which is the unknown in that contractual framework. And therefore, when IBC came about, there was a lot of expectations in terms of that the IBC is the code which will enable a resolution of distressed assets and possibly will work as a solution for stakeholders, including a exit for the promoters as well as giving opportunities to investors. Now, ladies and gentlemen, with this background, we open the discussion to the esteemed panel. And just to begin the discussion, we will go to Ashwini and ask him more from a lender's perspective that in terms of how has the IBC really worked for the lending community, and what are your views in terms of, do you think IBC has achieved its purpose, or what are the shortcomings?
Yeah. Yeah, Ajay, thanks. Let me, start before getting into directly into the IBC. As any investor in the distress space, he is, looking at recovering his money, right, with a return. So first and foremost, when he invests, like what are the challenges he foresees, whether those or any opportunities that he foresees, whether they are playing out as per their plan and expectations. See the so, as you rightly said, we thought IBC probably, it would solve a lot of problems that is involved in the distress investing. See, distress investing, the biggest problem if you see is that uh, there are in a single situation there are multiple lenders. So first and foremost challenge that we face is that whether all these lenders are a seller at the same point of time and at the same price. Okay, so that was one biggest challenge in this business, which we thought in IBC at one place everyone come together and sell at certain price because it is a auction or a price discovery is happening, which would solve the purpose. So having said that, so when any investor is looking at investing even through IBC framework, he is looking whether all the disclosures have been made correctly. So disclosure in the IBC framework today, it is a, I would say it is still a challenge, because only as a bidder into those assets I would only know what is disclosed by the corporate debtor, all the RP. So RP can only disclose what is known to him. So there are many unknowns which probably we are not even aware of, but we as an investor have to take a view on those unknowns. Second and foremost, I think we can debate a lot, but the timeline of IBC, though it is a time-bound process, but still we are not clear whether that is we are sticking to the timeline of recovery. Because so many cases we have seen those are litigations which have delayed this timeline of resolution to a very large extent when there is no end in sight. The third and more, another point is the ecosystem, whether there are enough demand for the assets that is being put in IBC. Because unless we have a very vibrant economic growth happening and there are stronger players who want to acquire these assets in IBC, we have not developed the ecosystem. We can put the assets into sale, but unless there are buyers, there is no price discovery happens. Then we have to go for multiple rounds of bidding to find, and probably lenders would expect at a certain price, but the market clearing rate would be at a much lower than what probably people are expecting to recover out of the situation. So what we see probably in the IBCs, there are a few large successes which has happened, and apart from that, there are probably many cases which won't get reported where the recovery probably won't be even as whatever people were expecting to get out of that process. But yes, when we do invest, we think IBC as a process would probably help us in our recovery framework. But having said that, as a lender, if I have already invested into a company, I am not today. I'm not so keen to take this company to IBC because I want to first give a try on a going concern basis with the existing setup, with the existing business, and then I will, if nothing works out, IBC is the last probably resort that is available to the lenders to take it.
Okay. Shailen, Ashutosh, Sumesh, you want to add anything in terms of, how have you seen IBC or the insolvency code has worked for the lender community? Your views on that?
I can come in more from the RP's perspective here. I mean, as Ashwini rightly mentioned, the recovery has always been a challenge, and that is why it's been said that the law has actually kind of failed to some extent. In terms of kind of giving the desired benefits to the creditors. As Ashwini mentioned, I think it's a little unperfect kind of an M&A. You have a situation where the information is imperfect. The RP makes best efforts in terms of giving the information, but the accuracy of the information or the completeness of information is something that he cannot vouch for. Typical M&A will have, say, presentations, disclosures, warranties, but we have a situation where none of this is something that is available to the buyer, and hence most of the unknowns are actually factored in the price. And the reason why we see the recoveries being as low as 5% and 10% in a lot of the cases, except some of the large steel companies where the resolutions are very high. Of course, there is also a challenge in terms of structuring. So, the IBC does not provide too much flexibility in terms of, kind of getting the related businesses into play. For example, giving the example of a large steel company, while the steel company was a part of the resolution process, but the related assets, say the captive port or a captive power plant, or the slurry pipeline, those are not really part of the resolution process. So if a bidder has to really kind of bid for a particular asset, he may actually want to see the value in all of this. And if there's any leakage or any kind of challenges that he's going to face going forward in terms of taking over those assets, all of those will actually get priced in the in the sales in the resolution plan or the resolution value that he's actually offering to the lender. So there has to be some way where some of this interdependent businesses actually can be integrated together, so that the lenders actually get a fair value of the assets that they are that is kind of part of the resolution process. I think the other important thing is also in terms of certain critical assets. Say, for example, we have seen situations where, say, critical brands are not part of the business. Those are actually owned by, say, promoter entities, and post a transaction, those brands may not be available to the resolution applicant. That can actually be a deal breaker on transactions, say a consumer business, where you have to actually end up spending a lot of cost in terms of marketing to bring the brand back in the market. Also situations, say the Jet Airways situation, if the clarity on the slots was available to the bidder at the time of the bidding process, maybe the recovery could have been very different. And we are still kind of struggling to find out what is the slots which would be given to the to the resolution applicant, successful resolution applicant after the process. So some of this imperfection, if we are able to kind of iron out, as a part of the process, then the value that we are seeing, that we are receiving currently, may actually be enhanced from what we are seeing.
So I think, Ashutosh, a question for you that, early detection of the stress and opportunities for investors at that stage, do you think is more feasible than go to the IBC? What, according to you, works well for the investor community?
Yeah, I think the investor community experience in the IBC is quite mixed as of now, right? And I would just divide the investors in two parts. One is the strategic, who actually end up acquiring the companies through the IBC, and second is a set of financial investors. So initial euphoria was that a good number of financial investors will find a place to trade on these assets and be able to create a market for these assets, which unfortunately has not happened because of the fact there is no defined timeline. the process can drag, and as Shailen mentioned that, imperfect information. So other than, handful of asset heavy large industries or large assets, most of the asset light businesses will struggle to find any solution, both for financial investors as well as strategic investors. And that's what been the situation which has come to light. And to your question, detecting it early, when the businesses are running on an asset light model, low on the assets and more on intangibles, business, customers, and roaring businesses, sooner they get into it, it's faster it is. And I believe that's where I think the role of the promoters might just come into the picture to really understand why some problems are occurring. And I think we can deliberate on it. That what is IBC meant for?
So I just like to add here that I think we are again faced with a situation where we have a good law, but we have an imperfect system of the implementation or a poor process of implementation. Now, for example, as Mr. Ashwini just said that, flow of information, and Shailen also said flow of information is not there, but you look at it from a different perspective. For example, under general law, before you come into insolvency, the regulation and the regulatory regime should be so strong that you should have perfect information. But why are we blaming insolvency or the IBC law for that? For the moment you come in, if the systems are good before the company has come into IBC, then you will have good flow of information. So it is not the IBC which is to blame for the lack of information or bad information coming in the hands of the IRP who has to run the system, but is actually a failure of the general law prior to that, because the system should be so strong that the moment IRP comes into the picture, he should be able to gather all the information. Why this lack of information is there? It is not because of IBC. It is because the processes which are prior to the company coming into the insolvency. Number two, look at it. As I say, it's a good law, poor implementation. Time value. Now, everywhere we are talking about time value. Now, if you make a law and you don't give infrastructure to the law, then what is the point of keeping 270 days and 330 days if you don't have judges who can run the system? We are running the insolvency regime as if we are running some civil law. You will have notices, you will have time to file reply, and at drop of the hat, we are getting stays from the NCLT and the MCLAT. Stay should be an exception, not a norm. So it has now become a norm that on drop of the hat, somebody goes, and especially, as Ashutosh is saying that promoters, they invariably play a very negative role in this. But then I feel that, it is a good law. It requires infrastructure both at the time when the company comes into insolvency, plus prior to insolvency, we need to have a, deeper look at that. Why are we having, microscope over the IBC and not a microscope over the Companies Act or the regulatory regime before that? Why this lacuna is there that if a company comes into the insolvency, why we have no information? Then it is not the failure of IBC according to me. It is a failure of the law before that and the regulatory regime before that. That aspect, I think nobody is considering and has not considered till date. That needs to be looked into.
Thank you, Sumesh. That was really helpful. So just to add a little bit on the disclosure of information. Now, as far as the disclosure of information is concerned, in fact, it is in the interest of the corporate data to disseminate as much as possible, because the law technically allows for, addressing all liabilities, because unknown liabilities in a resolution plan technically become zero, because that's how a resolution applicant would cover the financial liability. And as far as criminal liability is concerned with the amendment to the IBC, in fact, that part also has been clarified that going forward, a resolution applicant will not be held responsible for such acquisition. Now, having said that, where the resolution plan enables you to address the liabilities, Shailen, why is it, that the IBC process is not attracting the kind of investors or the volume of investors which was anticipated? How do we strengthen this? Because ultimately, if they are not off-takers of the assets, the success of the law is dependent on the market participation. So Shailen, Ashutosh, Ashwini, and Sumesh, what can be done in order to increase this market participation?
I think
sorry.
No, go ahead, please. Shailen.
So as Sumesh mentioned, we cannot have the law so prescriptive. The regulations are very prescriptive in nature. In terms of we need to do something within the X date. We need to have a evaluation metrics within a Y date. We need to have the RFRP in a particular date, and then any changes to the RFRP. So see, it's an economic law. If we kind of bring too much legal aspect into it, it kind of loses its flexibility, and that actually opens the matters for litigation. If you see the litigations that we are having and which we have kind of come across, so far, things like changes in the RFRP was done, with a short notice. There were changes made to the evaluation matrix, which could be detrimental to a particular investor. If we make the law less prescriptive, I think we will kind of have more participation coming in from the participants. Also, there has to be flexibility in terms of structuring. Like, for example, again, I will give a case of, one of the large, the real estate insolvency, which is based out of the NCR. You have a real estate asset and you have a road asset. Now, the road asset has nothing to do with the real estate asset, but they both are integral part of the entire resolution. You may find a buyer who may be interested in the road asset because it's actually generating cash. But a real estate player who might be interested in doing the real estate part of the of the business. Now, to have one bidder who's looking at both, and a resolution plan which kind of serves the asset requirement of both, it always becomes more difficult to kind of find a resolution in such situations. So if there is a flexibility available, and I believe the insolvency law committee is already looking at into some of this. If we have more flexibility in terms of coming up with a resolution plan, a way where we can kind of take out the certain assets which are non-performing or certain business which are not core to the to the main business, and we can work out a resolution which can be a win-win for all, we might actually see more participation coming in from players.
Just to add to what Shailen is saying, I think the most important, the most key word I would say certainty. For a investor, he needs certainty. He needs that, something is going to happen in a particular way and method and manner. It is going to happen. Here, the whole ecosystem is uncertain. So I think the best way to attract investment, both at the stage of CRP, where you need interim finance and money, and, later on for the resolution applicant, there has to be a certainty of the system. Now, look at the recent judgment where the Supreme Court has said you can't withdraw your plan. So, but Supreme Court has not commented upon the time taken by the NCLT. You sit over a plan where you say 330 days, you spend 2 years in deciding a plan, but look at the economic impact. So the investor today, actually that judgment is going to be a deterrent for people to come in, because, ultimately, if you have no certainty of system and you are planning to buy asset today, which you don't think will come to you after 3 years or 4 years or maybe 2 years, then who will invest? So I think that the key thing is to have a certain, from the infrastructure point of view, that you give us some certainty of the system where, how the process is run and how much time is taken. That investor has to know. You will get good investment. I'll repeat again, it's a good law, but the implementation, I am sorry, it's actually very poor on the ground level.
So Ashutosh, how difficult are you finding it, to ask investors to participate during an IBC process in contrast to a normal M&A?
I would say, let me just step back before, coming specific to this and look at a very positive side of the whole law and its implementation. We have in the last 5 years, couple of data points, not couple, there are plenty of data points where there has been a good amount of an exit for the stakeholders. And also the fact there have been strategic buyers who bought the assets. Now, if you look back in last 4 or 5 years and all the guys who have bought the assets through the IBC process, they're actually very, very happy. Means I'll be surprised. I don't have a survey, but I think 9 out of 10 guys will say that it was a great buy. And post the purchase of that company or asset, the going was very smooth. They didn't find any trouble significantly. They were able to get back to the health and what they got. Their performance is actually great. And I'm sure in a couple of years, there'll be studies which will get published to show what has been the performance of these assets under the new buyers. And did the new buyer find anything which were disturbing him post the purchase, which basically brings to the meaning that the law is greatly good. The law has given the buyers a really nice and a clean asset. So that's a one good data point to say why I'm coming to this, because that encourages more investors to come in, because that people are successful. So it brings in more people to say that this is a good way of buying assets, correct? So the success stories are reasonably in plenty, and as we go along, more and more data points will get populated around it. Second most important, which I feel is getting missed out, is that the whole IBC is still portrayed as a additional recovery mechanism for lenders. Okay, in the whole scheme of thing, one we are forgetting about is that this is basically an exit route for a failed business which couldn't live up to the expectation of its obligations. That is a moot point. So if you can glorify the people who are exiting also, which includes two people, one is a secure lender who's getting some money not to the best of the what he could deserve, and secondly the founder who is getting an exit completely out of his legacy problems and move on and get on to the life in doing something else. And I would also say, in my own interaction with the people or the founders whose companies have gone through the IBC and they have exited, they're actually very happy now, because what was happening to them last 5-10 years, they were hanging on to the asset, just fighting pillar to post to make the things work, fighting the tax, legal, this, bank, everything. They actually got rid of it completely legacy free going into this. I still don't know how the personal insolvency law will impact them, but as of now, most of the guys who have actually exited are really very happy and gives them a chance to move on in life. If we are able to glorify this particular aspect of this IBC code, that it is not meant to be an extension of the recovery process for the lenders, but it is actually an exit path for the founders whose business failed or failed to live up to the potential under their hands, and therefore it needs to find a change of hands in a cleaner way. It allows them also to move on in life. More and more these stories will come up. Then some impact data, elongated timeline. Because Ajay, if you also notice in last 4-5 years, the data on the time taken to close a case is not uniform. There are cases which have gone down very fast, and there are cases which have gone down too long, which basically means it is not the judiciary, it is something else which was at play. Correct. So therefore, I would say that if we really glorify some positive aspects of the whole thing, it's a great law. Investors who have bought the companies are very happy. Financial investors are still finding their feet to figure out how to make a play into the whole thing. I would say going forward, if it can be glorified as an exit mechanism for the founders and they see merit in it, then the timeline taken, imperfect information, their support, cooperation in the process, everything will increase manifold and we'll have far better success of the code.
Ashwini, a question to you. How do you think you could value maximize for as far as the lender community is concerned when a default arises because you have number of options available, and IBC is one of the options amongst the various options? So what is it that drives the lenders to take a company to IBC, and what are the things you possibly think will enable to create a better value during the IBC process? One of them being pre-pack, and are you in support of a pre-pack kind of an approach, or what are your views?
Yeah. So, see, definitely, IBC, as I said earlier, is probably, as a lender, it is a last resort, because as you know, as Ashutosh said, if a company is unviable, then only you take it. Like the business model is unviable, so you take it to IBC. So before taking to IBC, we would like to explore all other options, including whether we can work with the existing promoter in terms of giving him a longer repayment schedule, or giving him further, if there is a further liquidity infusion required to us, which can increase his capacity utilization, which in a way drives more operating profit. That's what probably the first you would like to do that. Second, a pre-pack where you can change the existing owner management to a set of new guys without going through IBC, but through a friendly kind of framework. That would be the second best option to explore. And if even that doesn't work out, you would go to IBC. So in IBC, the only point we have to ask those, as you said, we have to glorify like the exiting and the money made by the new investor. But the challenge is there, I just want to highlight as a contrarian to the process, what probably we will achieve in this process is that we make stronger companies by bigger company in the process, because they have access to capital market, They have access to probably more, capital from lenders to acquire companies at a probably at a decent valuation, a lower valuation, if I have to put it that way. So, and you basically, because a small entrepreneur who wants to achieve a medium-sized company, he probably cannot get access this capital market or the lenders to buy this out of IBC. So what we have seen in a way, if you analyze it, is that those corporates who have probably access to a larger lines or market, they have been able to buy bigger companies or buy through IBCs. And those smaller cases which nobody is interested, nobody is buying. But what we have achieved is that we have taken those smaller companies out of businesses. And if I don't have a good set of, as I say, I again go back to the ecosystem. If the RP who is running it at the time of IBC, he has to be an expert. Okay, expert at running it. Have we have enough experts, operational experts, to run these kind of companies who are in IBC? Okay, that is it, because I have, right now we have seen cases where, there is a lot of, a company has a lot of debtors. So debtors, those guys are not paying because nobody is following up. Really, like the one running company, promoter and management would follow up to get his receivables. So the debtor is just increasing, each month. So these are practical challenge. We have to develop an ecosystem of capital provider who would facilitate this kind of M&As in the IBC. Second, we have to develop a operational experts who, with the help of RPs, to run these companies well and as if they are being run by professionals, so that it can be handed over on a good stage to a new incoming investors.
Shailen, from your experience, what has been the case, when a RP steps into a corporate debtor? Technically, one of the primary obligation is to ensure the corporate debtor runs as a going concern. And running as a going concern means, there has to be injection of cash flow, because otherwise it is impossible to do so. And not doing it basically means there is value erosion. So what are your views, and how this entire thing can be sorted out and create a better value proposition for all stakeholders?
Yeah, so Ajay, as you mentioned, the first 2 to 3 months are the most critical. When you are stepping into a business, there is so much of uncertainty which gets created. The employee morale is down. There's an uncertainty in terms of the customers that you're dealing with, whether the company will be able to survive or not. There is a constant harassment from the regulators, for recovery of dues, for which, while the moratorium still exists, but you will still get notices, for cancellation of licenses and other things. So I think the engagement is something which is the most important, and the reason why we have been able to kind of been successful in some of our situation is the active engagement that we have been able to do. So for example, doing like a quick kind of a roadshow with the key customers to kind of give them the assurance that the business is going to continue as before, and you're making best efforts to kind of not have any disruption in the business. Similarly, like an employee town hall to kind of tell them that yes, the things are again, we are trying to maintain things as normal. The company will continue as a going concern. Vendors, in a situation that we are dealing with, we kind of told them that while you have outstanding dues for which there will be a claim process, but we needed their continuous support to kind of run the operations. So we actually changed the credit period to actually giving them the advance, so that at least they don't have to commit further working capital to the company. However, having said that, the critical issue remains is the funding for priority debt. A lot of the businesses may not be generating enough cash, and they may be need to have priority funding or interim funding, which would be required in the form of working capital or maybe certain loss funding also, so that the enterprise keeps running. Once you kind of stop the business, or once the going concern stops, the value that you're going to get is only the value of the asset. It will not be the value of the business. And if you need the value of the business, which is something that the lenders are really looking at, it is important to keep the business as a going concern. While there are enough provisions in the law in terms of priority of payment to the provider of interim capital, this market actually has not evolved. So we still have situations where we don't have enough, working capital or enough interim funding, which is required to preserve, or even in certain cases, for the business to survive. We are dealing with situations where, the lenders are not able to make a decision. I mean, and again, there is uncertainty whether the resolution will happen, whether it is, good money after bad money, whether, after funding, whether we'll make profit out of it. But some of it is just to keep the operations running, so that at least the value is kind of maximized when you're looking, when the investor is looking at a business, he is looking at as a continuous, as a going concern business, and the value will actually something that is a return the creditors will get. But somehow that appreciation is not there, amongst the creditors community, and we face a lot of challenge in terms of raising those priority debt from the lenders. While there are providers of capital in the market, you may have stress asset funds, ARCs, but I believe the lenders are the best fit to kind of give the priority funding, because they know the business so well. Being part of the COC meeting, they understand how the resolution process is shaping up. What is what are the issues, challenges in the business. Hence, it makes sense for them to actually come forward and fund some of this interim funding. However, this is not something that we are seeing in the market. If that is something that we are able to plug, I believe a lot of the businesses may actually get a better value than what we are getting right now.
Sumesh, despite the law actually, providing a statutory framework which protects priority funding, why is there a general reluctance, according to you, for the investors?
I think one of the reasons is the uncertainty in the system. If you lend money during the CRP, how you will get the money? Now look at this. We tried in 2 cases to get money for a real estate company. And what we were told was that please look at Amarpali. Amarpali is not in insolvency, but is being done by Supreme Court. They say the people are not giving money. So even if we lend you the money, where is the source of getting back? And priority lending it becomes a CRP cost, but it will get stuck. So if somebody is giving you money, they needed certain time frame. And if you are unable to return the money because resolution doesn't happen, then you may get priority, but the quality of the asset may not be that good to fetch you back that money. So even if you get some security of say some over the asset, then ultimately it has to be resolved, it has to be sold for you to get back the money. So from lenders' perspective, I think it's a very uncertain ecosystem. And even if I've seen cases where they're getting a better rate of interest, people are asking for 18%, 20%, 21% interest in such cases. But then they're looking at giving money in areas or in companies which they have a certainty of the asset or getting some security, and the time frame is there. Otherwise, the ecosystem, as Shailen said, as Ashwini said, is not there. It's not ripe. We'll have to create an ecosystem where people are willing to give money. You can't force money out of the lenders because lenders have already burned their hands. So to expect them to throw good money after bad money is not. It's going to be asking too much from them. So my view is that if you create an ecosystem, then maybe voluntarily you'll have people coming and giving money. Because as Shailen is saying, if there is no value in the business, then you are left with the assets. And then it is all going down to the wire to say that you're going to asset strip and sell the company. So I think preservation of value, we need to create an ecosystem where people come in, pump in money, and people like Shailen who are experts in running the company can keep it as a going concern and create value for the resolution applicants.
So Ashutosh, I know we have been talking about this, in terms of a potential RA looking to provide this interim financing, but on getting some right, like a ROFR right. Do you think if that kind of a approach is adopted, will it encourage investors?
Yeah, these are little, wildish thoughts borrowed from the Western world, correct? On what will help, in general, creating and enhancing the marketplace for these assets, right? So therefore, the concepts of strategic guy walking into a CRP process and ROFR, so he gets some preferential right to be able to participate and provide his interim financing and as a bidder. So I think that will open up a lot of guys to take that step. And second is the same, like it's a borrowed concept, like a stalking horse, So if you're doing a multiple bidding process, which is the one problem which I see in the IBC, is that while the EOI is very firm, the people who come into EOI can only participate. But for the final bidding round, actually there is no limit. You can actually walk in and put a bid whenever you want. There is no need to really adhere to any timeline, because the law is very fragile on that point. So therefore, if and these are not the problems which we are seeing. These are problems which are faced by the developed economies as well when they were developing their bankruptcy law. And that's where the concepts of stalking horse and these came up. And it really helps. The guy who puts in the first bid should have some preferential right or some share of the profit of the value which gets enhanced because of his bid. So therefore, I think those two concepts, if they come in, strategic are best placed to help build the marketplace for this priority funding. I personally feel that if strategic operator is allowed to come and work along with the RP during the CRP process to use the asset in a certain manner, and if he puts in money, that money is protected, and also he gets a preferential right to bid for the asset, it might just open up a lot of the problems that we are seeing. Eventually, you can do away with that law, but to start with, to build it up, it might be necessary.
Ashwini, you made a very valid point in context of, that it should not end up, IBC should not become, only helping the bigger ones to become bigger and a lot of small businesses to completely be out of business. Now, how as a lender are you going to, facilitate that, or what are the things which you think are going to best work for such kind of businesses? One is, of course, pre-pack, which has enabled SMEs to at least have that kind of an approach. But do you think they should expand the scope of pre-pack maybe to a larger segment of companies?
Yeah. The pre-pack, definitely, I think looks like it is a work in progress. So they have taken the first step for, SMEs kind of corporates. It should, I think, ideally evolve to larger corporate when a pre-pack would come. So I think that two things we have to, think through. In my view, IBC is like a Brahmastra. You have to use it at the end. Like if nothing happens, use the Brahmastra kind of situation. Okay. So before that, you have to have like other weapons which you should use, which doesn't kill the corporate data, but you try to think whether you can rescue the situation, whether you can make it good again without taking any drastic steps. Okay, so that's what we would do. For that, I think what is more important is that to be another ecosystem of capital provider. In many cases, if it is a real business failure because of liquidity challenges that we see, so as Somesh was saying, if existing lenders are not willing to put good money over bad money, there has to be a set of lenders, even if non-IBC situation I'm talking, before even take a step for IBC, who are willing to put capital, which would be say last mile funding to complete an incomplete project, or working capital to increase the utilization level. So this is a very that ecosystem today has also not evolved to a large extent in India. That has also evolved, which would also, if that evolves well and that risk reward is calibrated, then you would see less companies going to IBC and have a mortality there.
Thank you, gentlemen. I think, we are almost end of our time. Concluding remarks from each one of you, if you could just, say something in terms of, how this position could be bettered for both investors as well as the promoter or the corporate debtor which is in distress.
I would say, I think I would still see the glass half full rather than half empty.
Okay.
Yeah, I feel the same way. I think it's a good law, and with little bit tweaking and better infrastructure, I think we can make it workable. Earlier regime also failed of SICA because of lack of infrastructure. It's a work in progress. If government is willing and gives good infrastructure, I think it's a workable solution.
Shailen?
I think it's an economic law. As I said, we should bring in more flexibility, make it less prescriptive, and to the extent possible, we should avoid legal intervention, or lawyers' intervention.
Not lawyers. Ashwini?
Yeah, see, I think we have to make the law more like welcoming to the investor who is putting in money, whether it is strategic or financial, because anybody who is putting in capital, so law and has to facilitate that and welcome that investment.
Thank you, gentlemen. I think with this, we can conclude our session. Thank you very much.
Thank you.
Thank
Have a
you.
nice
Thank
day.
you.
Thanks, Ajay.
Thank you. Bye.